Hello and welcome back to the MD Investor channel, the channel where we talk about setting goals, achieving goals, breaking the cycle of generational poverty, making smart money moves, teaching our children financial intelligence so they can really live this American dream and not just work for every single penny they have. Wayne Abrahams again, new video today. Today we're going to talk about passive investing versus active investing. Passive investing versus active investing. Don't forget, on YouTube it's MD Investor. Definitely subscribe. Hit the subscribe button and hit the notification bell so you'll be notified when new content comes out. On Instagram it's MD Investor 1. So passive investing versus active investing. Passive investing. What is that? Sounds lazy, that's laying around doing nothing. Passive investing, also called index investing, is to be differentiated or compared to active investing. That's important because the reason why I tell you guys to definitely go online and check what you're invested in and not just assume people have your best interest at heart is because you might be in active mutual funds and you don't even know about it. We're going to get into that a little bit. So passive investing is basically having your investment track an index. So the index, you hear them on TV all the time. The Dow Jones Index, the 30 of the biggest companies in America. You have the S&P, or the Standard & Poor's S&P 500, 500 of the biggest companies in America. There is some other indexes out there, but essentially they are companies that they track, okay? So when they say you are a passive investor, you are tracking one of these index. You may have a fund that tracks the Dow 30. Some of the most popular index funds out there are S&P 500 index funds. They basically mirror or track the S&P 500. Compare that to active investing. Active investing is basically when you say you're in a mutual fund, and it's an active fund, meaning you have to pay fees because there's a fund manager there actively trying to pick the winners, right? There's a huge economy with multiple, large hundreds and thousands of companies, and we don't know who's going to go up, who's going to go down. So you're paying a premium to have these stock investors or these stock or portfolio managers, let's put it that way, portfolio managers to try to pick the winners. I think this one's going to win. Let's go buy some of this. I think this is going to win. Let's go buy some of this. You're paying a premium for that because they're the quote unquote experts. So you got to pay a price for that. And the price you're paying is high fees. Sometimes you'll hear stuff about a front-loaded mutual fund or a back-loaded mutual fund. Basically, either you're paying fees when you're entering to buy the fund or you're paying fees when you're leaving the fund. The bottom line is, if all you can remember is that fees eat away at your return. So that goes back to the question. I had a video, how do your investment advisor get paid? You never write them a check. Some of that kickback, or those fees that you're paying for those fund managers to try to beat the market, some of those kickback is going to him for bringing the stool pigeon, bringing new clients to him or her. So active investing is basically people trying to beat the market. Okay, the S&P 500 is doing this. I'm going to try to do better, and having these experts pick these stocks. It's going to cost us money. And what it's going to show also is that the studies have shown that they really cannot beat the market. The overwhelming majority of actively managed fund woefully underperform the market. They underperform the market. So the question is, if they underperform the market, what am I paying you for? Exactly. What am I paying you for? Right? Your fees are eating into my returns and you're underperforming the market. Well, it would have been better just buying the whole market. And that's what the passive or index fund is. You're essentially saying, since it seems like we really can't beat the market and only a very small amount of funds beat the market, and then when you consider the fees that you're paying them, either way the return, what's left over is probably not significantly better than the market. So why not just buy the market? And that's what an index fund is. You're essentially buying the whole market. You're saying, you know what? I'm not good enough to be picking the winners and the losers. So therefore, I just buy the whole thing. Okay? And it's cheaper. And a passively managed index fund is cheaper to manage because all they're doing is mirroring the market, right? So if the S&P 500, let's take an S&P 500 index fund, and let's say in the S&P 500, technology represents 5% or 15%, then they will also in their index try to in their index have 15% represented by technology. If consumer staples represent 5%, likewise they'll have it represented this way. So it basically mirrors the market. So it's going to perform just as the market. The market goes up, your index fund is going to go up. The market goes down, your index fund is going to go down. You're basically going to mirror the market, and you're not worrying about winners and losers. And the good thing about it is that over the last, say, 40 years, let me back up. The market always tends to go up and to the right. That's how the market tends to go, up and to the right, always upward. So the market continues to go up, okay? But you have to be patient, okay? Remember in 2008, market went down, people got scared and went in and started selling at the bottom, which you don't want to do. What eventually happened? The market came roaring back, okay? So just remember that concept that the market always goes up and to the right. Okay, now, so we've established what is an index fund. It's basically a fund that mirrors a particular index, whether it's a Dow Jones or S&P 500, and we've shown that these funds have tended to do better than actively managed fund. One, because they're performing just at the market, and there's less fees associated with them because there's less fees to manage. Okay, they're not buying and selling all the time. They're not paying exorbitant fees and salaries to portfolio managers to try to manage these and pick the right stock, which they are unable to do in any significant way. So therefore, more returns for you. A lot of times they'll say, passive investing is just for lazy people. No, it's for smart people, okay? Because why am I paying you more fees for poorer return, right? That makes no sense. I'm giving you all this money and you cannot perform better than the market. So why don't you buy the market? And that's essentially what you're doing. Instead of buying with this stock and this stock, you buy the entire index, okay? So you have a little Apple, you have a little Google, you have a little Johnson & Johnson, you have a little McDonald's, you have a little Caterpillar, whatever you can think of. You have a little of everything, okay? You have the whole market. The market goes up, you're gonna go up. And over the last 40 years, right, from 1975 to about 2015, the market have given an average annualized return of about 11.9%. If you include dividends reinvested. 8.7% if you do not include dividends reinvested. So that's pretty good, right? if you remember the rule of 72, you take 72 divided by your rate of return. That gives you the number of years that it takes to double your money. So if over the last 40 years, 11.9, let's round it out to about 12% return. 72 divided by 12 is going to be about 6. So every 6 years, your money on average would be doubling. Every 6 years, your money would be doubling. Okay? That's great, right? So there's a little touch on passive investing, index investing, and why absolutely it's the way to go. One, it's the performance is excellent. Two, the fees are much lower than actively managed fund. And that's why I said, guys, you should go in and look into your retirement account. What do I own? What do I have? A lot of times we assume. Okay, go in, type in the ticker symbol, go to Google, and it'll come up. This is the mutual fund you have, and there is a 5.5% front load fee. Woo, I really didn't realize that. Yeah, you're getting robbed. Okay? Or there's all these fees, 2% and all these fees, and you're like, oh, this is eating at me. Something like S&P 500 index fund from Vanguard, great company, has an expense ratio of 0.04%, which is basically you're paying about 40 cents for every $1,000. Correct. 40 cents for every $10,000 you're investing. It is very cheap. The bottom line, it's very cheap. Absolutely, it is the way to go. Okay, why do it? Well, we kind of went through some of that. Why am I going to do an actively managed fund? One, it's like set it and forget it, essentially. Okay, I'm following the market. I'm riding. Okay, the market's going up. I'm going up. Two, the performance is better. It's simple. I don't have to confuse myself. And a lot of times, guys, the bottom line is, you watch all these commercials, all these commercials from all these companies, Fidelity, Prudential, Raymond James, E-Trade, all these companies. They make investing complicated. You need a financial advisor to hold your hand, to make sure your retirement is safe and you won't run out of money in retirement. But the little stuff, the little fine print, they're not telling you, that we're actually getting 5% of every dollar you're investing, and the whole thing's not going in, and your performance is not going to be as great as it could be if you were to follow the index fund. Guys, we really are not able to beat the market. You probably would have been better off with the index fund, but we can't tell you that because we have a whole industry we have to support. So they have a nice suit on, say here you are, and come into the office. But the bottom line is, it is the way to go. Okay. Can you do better? Essentially, the quick answer is not really. I mean, there's very few people that can beat the market. I mean, it's very, very, very rare. I mean, you're talking about people like Warren Buffett and all these stuff. But the bottom line is, essentially, no one can beat the market. Okay? No one can beat the market. Either they're going to buy it at the peak, okay, and then maybe they're going to sell at the bottom, or they're going to get out when they should have come in, or they're going to pick the wrong company. No one can really pick the market 100% of the time. Index way is the way to go. Basically, we have busy lives. We got to live our lives. We can't spend all our time focusing on this stuff, okay? That's why index fund is absolutely, absolutely great. Okay, we say we're basically tracking the market, right? Market goes up, great. What if the market goes down, right? So we bought an S&P 500 index fund, great. We're following the market, we're saving money on expense ratios. Beautiful thing, they're going wonderful. But what if the market goes down? The market goes down, right? It went down in 2008. It went down before that, and it's going to go down again. What if the market goes down? Well, as the market goes down, consider it a sale. If the market goes down, consider it a sale. Now look at this. People go crazy, right? Black Friday and all this stuff. When it's time for Christmas, this flat screen TV was $1,200. Now it's only $600. People go, oh, I'm gonna get two. I'm not just one. I'm gonna get two TVs. The Mercedes Benz was $100,000. Now it's only $95,000. I'm going in. I'm gonna get it. When anything goes on sale, people go crazy. The iPhone X and the iPhone 10 is on sale. I'm going in. Everybody's happy when there's a sale, except for the stock market. When the stock market drops, guys, don't you realize that's a sale? Right? If this company shares in this company is selling for $100 a share, the stock market dropped 50%, and now the same company is worth $50 a share. People, their hair is, pull their hair out, they're gonna jump out the building, but it's a sale. But they don't see it as that, right? Instead of $100 a share, you can now buy it for $50 a share. That's what happens when the market drops, right? You go in, as they say, back the truck up and just get all that you can. All that you can. Because what did I say before? The market tends to go up and to the right. So you go in there and you're getting stuff at half price, at a discount, value. And when the market goes up, as it always does, you'll make a lot of cash. Okay? Of course, it depends on your time frame, to be all honest, right? If you were about to retire in 2008, and say you had a portfolio of $1 million, and say the market dropped 50%, your $1 million portfolio is now worth half, $500,000. I mean, to your psyche, that could rock your psyche. That's why it's important to have what they call asset allocation. So you're not going to have, as you get older and older and you're getting closer to retirement, you're not going to have 100% of your money in stock. You're going to have a little in bonds to kind of smooth the ride. There are going to be other videos on asset allocation. But suffice to say, you would try to ease that or smooth that ride out by having some of your money in bonds so you don't get the full jolt of the market dropping, okay? Because you're not 100% in stocks. Okay, so guys, just a quick video, guys, about passive income or index investing. It's going to be a great tool for us to use. The returns are fabulous. We basically, we can buy a total stock market index fund, like something that Vanguard had, like VTSAX. Other company has it, but I love Vanguard. VTSAX. It's a total stock market index fund that basically tracks the entire market. In it, it had about over 6,000 stocks in there. See that? That's what you're talking about diversification. 6,000 stocks. You buy that one fund, and you have about exposure to 6,000 stocks. So you have you have Apple, you have Google, you have Netflix, you have Johnson & Johnson, you have McDonald's, you got Pfizer, you got Caterpillar, you got United Technologies, you got Pepsi, you got Coke, you got everything, okay? That's what you call that's what you call diversification, guys, okay? And look, passive income is the way to go. We're going to get great returns. Our fees are going to be less, so more of the money comes to us as opposed to giving it away to other people. Our performance is going to be a lot better. That's the way to do it, guys. You're contributing every month. Every month you're contributing. If you're lucky, your company is giving a company match, and let that money just ride and compound. That's how we're going to do it, and we're going to keep more of our hard-earned money. So just remember, guys, passive income. Correction, passive income is good too, but passive or index investing is definitely better than active investing, because the active investors, the stock pickers, and these actively traded mutual funds cannot beat the market. One little tidbit to drop in your ear before we close off. Warren Buffett, the famous Warren Buffett from Berkshire Hathaway, great investor, great investor, says when he passes, he's going to leave, obviously going to leave his money to his wife, and in his will, he wants 90% of that money to be invested in an S&P 500 index fund, and the other 10% in government bonds. He's going to keep it simple, right? Was it Bill Clinton that said, keep it simple, stupid? Keep it simple, stupid. I'm not calling you stupid, but keep it simple. 90% he's saying in an S&P 500 index fund. He said the average or casual person, average individual investor, should invest in an index fund. You know, we have jobs, we ain't got time to be studying all the individual stocks or turn it over to an actively managed fund who can perform better than the market and paying all his fees. He said it would be better to buy the whole index, buy the whole market. Okay? So if it's good enough for Warren Buffett, it's good enough for me and it's good enough for you. Okay? Just remember, guys, MD Investor again in the house. MD Investor again in the house, talking about passive or index investing. Again, setting goals, achieving goals, breaking the cycle of generational poverty, knowledge, and action. Combine them together, guys. You're going to be a powerful force. Don't forget, guys, that there's friends and family out there who are struggling with personal finance. Hey, let them know. MD Investor in the house. We're talking about some real stuff out here. Okay? We're talking about breaking the cycle of generational poverty. Breaking the cycle of generational poverty. Okay? Our children are going to be a lot better than we are. We're going to be better than our parents. And they'll keep going on and on. Okay? So, MD Investor 1 on Instagram. MD Investor. Don't forget to like, subscribe. And we're going to see you on the next video, guys. On the next video, we're going to see you, MD Investor.